Hello and welcome. Good morning, good afternoon, good evening to everyone who has joined. My name is Cynthia McHale and I'm a Senior Director at Ceres, your MC for today's live streamed Ceres 2020. Ceres, a sustainability nonprofit. We are working with very influential investors and companies from around the world on a host of global sustainability challenges, including water risk, both scarcity and pollution, the climate crisis, and deforestation. I would like to start today by saying that our hearts go out to all of those, really all of us, seriously affected by the global pandemic, and we are especially grateful to those on the front lines, risking so much and working so hard to ensure we all stay as healthy and safe as possible. I also want to thank each of you for participating today. We realize that your personal and professional lives have been profoundly disrupted and in many ways really quite unfathomable just weeks ago. But your unflappable commitment and courage shown by your participation today is truly inspiring. I also want to thank the generous commitment and support of our speakers and sponsors who have stood by us on this digital journey to reimagine Ceres 2020. It is so appreciated and must also be highlighted. We clearly would not be here today without your essential support. Somehow, against all of the odds, we are able to transform our intended in-person convening into a digital program together. The profound commitment and conviction of so many in our community to address the dual existential threats that are plaguing our global community is inspirational. So for today's session, let me give you a very brief description. The goal of Climate Action 100+ initiative is very clear: to persuade companies to scale up their ambition and reduce greenhouse gas emissions to achieve the goals of the Paris Agreement. In this session, participants will define critical sector progress, priorities and milestones, pinpoint effective engagement strategies to drive a step change in company ambition, and identify critical barriers and offer solutions to achieving real progress in 2020 and beyond. So with that, I would like to introduce both our moderator and our speakers. We are absolutely delighted. First, Ann Simpson, California Public Employees Retirement System, CalPERS. Ann is the Director of Board Governance and Strategy, reporting to the CEO and responsible for strategic initiatives across the $400 billion fund. Ann has been at the very heart of Climate Action 100+ and led its launch in 2017. Ann also serves on the SEC's Investor Advisory Committee, Senior Advisory Board of the Center for Responsible Business at Haas Business School, UC Berkeley, among many other positions that Ann holds. So let me also introduce our three panelists, please. Adam Mathews. He is the Director of Ethics and Engagement for the Church of England Pensions Board, as well as co-chair of the Transition Pathway Initiative and a board member of the Institutional Investor Group on Climate Change, IIGCC. Adam also serves as a member of the Royal College of Physicians Investment Advisory Board and on the Pension and Lifetime Savings Association Stewardship Advisory Group. Next, we have Sylvia van Waveren, Environmental Engagement Specialist at Robeco. She is on the active ownership team, and she is also a member of the UN PRI Working Group on Methane Emissions and a member of ICCR Climate Working Group. And we also we're delighted to have Seiji Kawazoe, Associate General Manager, Sumitomo Asset Management. Seiji has global experience based in Tokyo, New York City, London, Luxembourg as a global equities portfolio manager. He is also a part-time lecturer, Graduate School of Tokyo University, and a visiting fellow at Henley Business School, and is joining us just about midnight from Tokyo. So thank you so much, Seiji.
I'm absolutely delighted that we've got a number of the most significant and influential leaders in Climate Action 100+ here to join me to talk about not just the individual companies that we're tackling, but this issue of sectors. Because what happens in the oil sector is going to be affected by what happens in transport and energy use and aviation and other sectors create the demand for the fossil fuels. So we can't just look at companies individually, one at a time. We need to understand how the economy is interconnected. So that's something we're really going to dig into a bit on this webinar. And it's something for Climate Action 100 Plus that we're beginning to grapple with. So before I turn to our speakers, for those of you who don't know Climate Action 100 Plus, as Cynthia said, this is an initiative which goes back 2 years now. It was launched 2 years ago at the One Planet Summit in Paris. And the origins of the initiative are carbon footprinting, which sounds like a rather worthy and tedious thing to be doing for a very big global investor, but carbon footprint, I don't know where that metaphor ever came from. I don't know why feet were the thing to measure when we're thinking about global warming. But the idea of a global footprint, a carbon footprint, is you take all or part of your investment portfolio and identify where the emissions are coming from. Greenhouse gas emissions, obviously. So that means carbon, that's shorthand, carbon and carbon equivalents, because there's obviously other emissions that cause global warming as well as carbon. So when CalPERS signed up for doing a carbon footprint as part of supporting the Montreal Pledge, this was a PRI challenge to investors to say, in the run-up to the negotiations around the Paris Agreement, investors need to do their bit. They need to know where the emissions are in their own portfolio. So fair enough, CalPERS signed up. We've got something like well, over 10,000 holdings in our global equity asset class. And to our shock and amazement, 80, that's 80 companies were responsible for the majority of emissions, measured on scope 1 and scope 2. It was a rather simple and primitive way that we were counting things back then. So with that insight into the CalPERS portfolio, it's pretty clear that, well, if this is true for us, it's probably true for many other investors as well. And we had a series of meetings which were hosted by the French mission to the United Nations. François de Lattre was the ambassador to the UN at that point, and Sophie Lelias also played an important role. So this work was shared with other investors. Series came to these meetings, also PRI, the investor network in Europe, Australia, and Asia, to really start looking and saying, okay, well, if you face a systemic risk, it's not just the tragedy of the horizon, which Mark Carney has written about so eloquently. You know, things that might happen in the future, it's very hard to, you know, bring that back to the present. Although, to be honest, for a pension fund, that's our day job. You have to be thinking about the very long term and what it means for you immediately now. But the tragedy of the horizon was something that Mark Carney wrote about. But it's the tragedy of the commons that we face when we're dealing with a systemic risk. And what does that mean? It means that there are certain public goods or common goods in society where each individual user of that good may not have an incentive to look after it. So the old-fashioned example is there's a village green and there's a community around the green. All the animals are grazing on the green. However, if all the animals keep chomping away at the pasture, eventually it's going to be ruined and there'll be nothing for everyone. So we have a shared responsibility to take care of the global public goods. And our natural environment is clearly one of those global commons. It is a global common good. And the way that climate change is being affected by human emissions, it gives us an understanding that actually we have the ability to stop this. So that's really what Climate Action 100 Plus is all about. We've brought a community of fellow investors with facing the same issue, the systemic risk of climate change. I would also say it also poses opportunity. We don't just view this as all doom and gloom. We see huge opportunities in the energy transition, which is upon us already. Well, the three goals of Climate Action 100 Plus are simple, but they're powerful. The first is a governance goal, where we're calling on companies for boards of directors to take responsibility for climate change. That's for these companies that are so critical to the transition. But not just to take responsibility, we also want to see executive pay and rewards, incentives lined up with the goals of meeting Paris Agreement ambition. And we also want to make sure that companies are not using shareholder money to lobby politically against or to undermine the goals of the Paris Agreement. So when we say governance, we mean the whole shebang, the whole thing. Who's on the board, their competence, their ability, their responsibilities, and all the incentives and activities the board's responsible for. So that's goal number one. Number two is to set a target in line with Paris. Now, the words in the Paris Agreement were charmingly vague. They said the goal was to keep global warming to well below 2 degrees. I think that is now completely understood to mean 1.5 degrees. Since, in the last 5 years, that's been firmed up, and certainly for Climate Action 100 Plus. That means net zero by 2050. We're getting very specific on targets. The third goal of Climate Action 100 Plus is to have companies disclosing in line with the TCFD, the Task Force on Climate Financial Related Disclosure. So those are the three goals. What we're going to look at with our panelists on this webinar is this issue of the sector dimension to the Climate Action 100 Plus ambition, but also to ask each of the investors who are part of the webinar to highlight what they consider to be the progress that we can point to and the lessons learned, but also to look at the barriers because we're only 2 years into this project and we've got a lot more to do. So, Adam, if I can turn to you and ask you to share your thoughts on where we've got to, what we need to do next, and in particular, this sector dimension to the work. Thank you.
Thanks, Anne, and thanks everyone for joining, and good to join from the UK. And echo Anne's comments in relation to the times we're all navigating together, and the need to remain focused on other systemic challenges like climate change is absolutely right. I mean, we've approached Climate Action 100 from the sort of premise that no individual fund, however large, however influential, is going to shift the response by themselves. This is a collective endeavour. It needs a collective response, and for us, Climate Action 100 is the vehicle for the Church of England national investing bodies and the pension fund that I work for and our beneficiaries. So this really is the key tool of intervention on engagement, and it's hugely impressive where it's got to in terms of funds supporting it, in terms of the focus it's got, and the fact that it is bringing together all the investor networks in the collaboration in a way that's never been seen before. So our sense is this is the mobilization of the investor community, and it's the game in town to drive the change that's needed if we're going to achieve the Paris Agreement. And I think investors have an absolutely unique role, given their investments are global, given that many of us are invested across multiple sectors and industries through value chains, and therefore we touch whole rafts of the economy that need to change, and we have a fundamental role in shaping that, both in our beneficiaries' interests and in terms of their interests to retire into a world that isn't ravaged by climate change. So that really gives the basis of why we're so supportive of Climate Action 100, why we've sought to play a very active role in it. And I think we're at a fascinating point, really, where obviously we're sort of understanding, navigating the current in terms of COVID-19 and the impact that will have, which will mean that we're going to have to change some of the ways that we potentially respond, but potentially could mean things could happen quicker in some regards. But in terms of the change you're seeing, I think CA100 has had some very notable successes, and I think when you look at the sectors like oil and gas, 3 years ago, realistically, we couldn't actually determine what a commitment was from an oil and gas company based on public disclosure against 2 degrees. And now I think we're at the point where at the cusp of being able to differentiate between which companies amongst some of the largest are making genuinely aligned commitments covering all of their impact, scope 1, scope 2, and the use of their product, scope 3. And I think you'll see in the coming weeks an understandings begin to emerge of what good practice looks like related to net zero. Sylvia and I obviously have tag teamed on behalf of Climate Action 100 in the engagement with Royal Dutch Shell, and there we feel the announcement that was made last week by the company was a very significant one in response to the engagement with Climate Action 100, and I think Sylvia will probably pick up on some of the detail on that in particular. But one of the concepts that was introduced very much in the Shell engagement, and one that we support, is the acknowledgement that Shell can't do this by themselves. Yes, they can make commitments. Yes, they can be committing to reductions in scope 1, scope 2, scope 3, but actually not all of it's in their control. Yes, we want to see the plan, we want to see the strategy, we want to see it connected to executive remuneration, and we want to see the lobbying aligned, but actually there's also acknowledgement for them to achieve it, that there's a raft of sectors, be it shipping, aviation, freight, auto, that are going to have to change to enable them to deliver their strategy. Now, they introduced the concept last week that for those in companies that they supply energy to in those sectors that don't change to net zero plans, they're potentially willing to not sell energy to them. And for us, I think that was a really significant step, which both raises a question for Climate Action 100 about engaging through the value chain and actually an alignment of interests. As a pension fund, we're committed to net zero. And actually, you've got a company here, you've got other companies making commitments to net zero. I think we've now moved into a territory where there's an alignment of interest to drive transition through the value chain and actually working together in a very different way from just engaging that individual company. And so our sense is that that will be a really important part of the agenda that Climate Action takes forward. And I think there's a lot of learning in the achievements that CA100 has had in the oil and gas sector and in other sectors as well.
Thank you very much, Adam. And thank you for all the tremendous work that you and the church crew, I call you for short, that you've been doing for Climate Action 100+. It's very important. As you rightly said, your partner in this work is actually over the border. One feature of Climate Action 100+ that's important is the global collaboration. So I'm truly delighted that Sylvia van Waveren from Robeco is able to join us. And Sylvia, would you like to continue that theme on the significance of this commitment to start moving on sector issues, which came out of the Shell announcement last week? And again, congratulations to Robeco for that tremendous work that the two of you have led on behalf of a number of investors who are collaborating in this area. Thank you.
Yeah, thank you, Anne. I'm really pleased with the outcome, of course, that Adam and I, on behalf of Climate Action 100, had at Shell. To give you a brief introduction and a feel factor about what it means for us as investors to engage. For us, it is a very important tool to use engagement for managing our climate change risk and opportunities in our portfolio, and also the portfolio of our clients, obviously. Our view is that the energy transition entails some sectors incurring financial losses arising from volatile adjustment to asset values or the higher cost of doing business, and how companies respond to these issues can basically influence their financial results. And companies, we strongly believe, that are able to adapt will be the winners of the transition, and we would like to know these companies in an early stage as investors. And therefore, we target our engagement program very carefully, and we target it to the high carbon emitters, high footprint companies, and we target, as a result of that, oil and gas companies, electric utilities, cars, and chemical companies. And a key element of that climate change engagement is our collaboration with Climate Action 100, where we stood at the beginning by offering our engagement capabilities that we built up for years in a couple of companies. So we offered a leading or co-leading role for Shell and Enel, and that's how Adam and I we're the team in the lead for the Shell engagement. Yeah, I think what have been very effective in that engagement with Shell, and I believe you all had seen the results, and I come back to that a bit later, is that if you are backed by a major and strong collaboration of investors such as Climate 100, this leads and could lead to great results. We already see that leaders in the energy transition have begun already to stand up, claim net zero commitments, and adopt stronger commitments to decarbonize. So it has been really a journey of much interest to us as investors. Yet at the same time, it's also challenging. Being such a big collaboration means a lot of collaboration, and I'm also happy to say that the collaboration with the secretariats of the platforms like IIGCC, Ceres, PRI, and also the Asian ones are very helpful for us. And I have to be honest, Adam and I are very much struggling in keeping all the investors that are supporting us in, for example, the engagement with Shell, happy and updated. This is really a challenge, and we get some feedback from those investors that we do not do enough or do not explain enough, or that their questions are not answered and taken to the company enough. We value that feedback, and we do our utmost best to channel them, but it has been a challenge. And now I come back to the biggest barrier, and Adam already touched upon that in his introduction speech. It is for oil and gas companies absolutely needed to ensure the world access to affordable, reliable, sustainable and modern energy, and development of these zero or low emission energy sources is part of the solution. But it will require not only very many innovative technologies, such as, for example, carbon capture and storage, or other technologies. So we need those oil and gas companies. We need those companies to invent, innovate, and achieve these technologies, and they play an essential role in it. But also, and that is the big, I think, the big message of today. Shell cannot do this alone. Oil and gas companies cannot do this alone. They need to work with their customers, their clients, to address the emissions that are produced when those clients use the fuels they buy from oil and gas companies. And each sector that does that will need to find their own way to achieve net zero emissions by, for example, becoming more energy efficient, using lower carbon products, and thirdly also by storing away the emissions they have. And Shell now has said in its last commitment to us a week ago that they are going to push progress in this area towards these value chains, and that they will even pivot themselves over time towards serving only those businesses and sectors that are with them on that journey. So in a way, that changes also our engagement with the oil and gas sector. We need Climate Action 100 fully for this. We need to change our engagement and not only, for example, engage with each and every company in the oil and gas sector, but change our engagement in the whole value chain. And I'm looking forward to taking up that challenge. And I'll leave it at that. So, Anne, back to you.
Thank you very much, Sylvia, and again for this tremendously important work that you're leading with Adam. Seiji, thank you so much for joining us. It's wonderful to have you with us. Asia is such an important part of this global challenge that we face with climate change.
Yes.
So would you like to share with us your understanding of this challenge and what you think the solutions are from Sumitomo's point of view? Thank you.
Yes, so I'm based in Japan, so maybe I'm specifically talk about Japanese experience, but in terms of this Asian regions, each country has its own sort of government policies, and I think government policies are very important, and I think at the level of the government sort of commitment is a very important sort of things to watch in the first place, because the reason why in case of Japan, the investment community, business community started to focus more on these climate change issues these days is because of the capital market reforms that government has started to take since 2015, and the involvement of the public sector funds such as GPIF or the Bank of BOJ putting in have more stake in the companies that make investment, and therefore there has been more momentum of integrating ESG into the investment process, and that's why in Japan you have more momentum of ESG investment, therefore integration of environment, social issues into the investment process and policies. And I think that is a very sort of strong sort of tailwind, so to speak, for in case of Japan. And in addition to that, I think most recently the Japanese government has sort of made the commitment through a consortium called TCFD consortium since last year, and this consortium is a network of public institutions like Ministry of Finance, Ministry of Environment, and also Ministry of Economic and Trade and Industry. So all the government institutions have came together and had made a sort of public sector support to have this TCFD consortium that companies have signed up for this consortium. More than 250 companies are now the member of this consortium to support the TCFD disclosure. So with this backdrop of this sort of tailwind of the public sector support, I think the Climate Action 100 plus activities in Japan is well kind of accepted, raised awarenesses. So that is helping our engagement activity with the companies like the Nippon Steel or the Hitachi or Toyota, those are larger manufacturing companies, which are generally conservative in terms of its sort of policies on these ESG issues. But I think they are more committed than before because of this TCFD consortium that became an industry-wide or the country, the sort of all sector involvement of the companies. So we expect, the 250 companies are now the member of the TCFD consortium. So we expect these 250 companies will start reporting on the climate action, and so we have much more, so to speak, a volume of these the company's disclosure in the marketplace. So I think so in terms of this disclosure wise, I think Japan is now relatively ahead of the curve now. And that does help the engagement activities of Climate Action 100 plus as well. So I think the government involvement is quite important for each of the countries in Asian countries. I think the countries like South Korea, last month we had I think they had an election in South Korea, and I think this progressive side of the government has sort of won the majority. So I think that does make some much more positive momentum in South Korea as well. So I think each country has its own sort of agendas and also the policies, and I think we need to have that public sector engagement or the contribution will be quite important for all the Asian countries. That's my observation.
Thank you very much, Seiji. How this project on climate change works, North America, Europe, Asia, Australasia, we have to have a global strategy because this is a systemic risk, and it's not something that we can't hide from it, and we can't tackle it in one corner alone. And the other important point you're making is this need for partnership between public sector, business, finance, and also, I think, civil society in moving this forwards. So let me turn back to Cynthia at Ceres. We wanted to make sure that on this panel that we take questions from people who've dialed in for this webinar. Cynthia, can I ask you to kindly let us know if any questions have come in through the chat function?
Sure. Thank you so much, Anne, and thank you to all the panelists. So we do have a couple of questions, and I will just read them off to you, Anne, and then you can decide how you'd like to field it. The first one here is, I'm curious to hear the panelists' thoughts on how investors can accelerate the adoption of Scope 1, 2, and 3 targets at companies in their investment portfolios.
Thank you. That's a very good question. Adam, would you like to take the first crack at answering that? Thank you.
Yeah, sure. I mean, I think, to be honest, this is what CA100 is doing. There's a clarity of ask that I think has been articulated through CA100 that is being transmitted not just on behalf of my pension fund, but on behalf of all those hundreds of funds that are involved in CA100. And when you go and talk to them, you're doing it on behalf of $42 trillion. So my sense is that sort of request, engagement objective is there, and it's clear, and I don't believe that any of the 160 are unaware of that. One of the tools that are used by CA100 is the Transition Pathway Initiative, which provides the sort of public sector indicator framework for measuring company progress. And the companies that are assessed by TPI within the CA100 group, we've got about 60–70% response rate to the London School of Economics on their individual assessments, which is an absolutely huge rate. And that's reflective that those companies know that investors are engaged in them. They're looking at their the indicators that are assessing the progress that's been made. If your question's broader than just this 160, I think that what you're seeing is good practice being established within sectors, and basically rules in the sense of what investors are expecting in a sector like oil and gas, or in mining, or in utilities, and those will become the norms that will then flow through from the larger companies to smaller and medium-sized companies. So my sense is that these are absolutely critical sectors, absolutely critical companies, and the demands and the requests that we're making here will flow through to the wider markets as well. And obviously we have then tools as investors, not just things available to us such as engagement. We can look at the way we utilize our voting. We've just, as a fund, created a passive index that could embed the insights of TPI to specifically support the goals of CA100, so that you can actually positively overweight companies in our passive investments that are actually aligning with the goals of CA100. We will double our investments in those companies that make those commitments and are demonstrating through public disclosure. We will also not allow you to be part of the passive index if you are not disclosing that basic information. Now, I know my passive funds, £600 million is our commitment, won't change the world on that, but I do know that many other funds are looking at a similar kind of way of being able to sort of really bring their passives into play behind stewardship objectives of CA100. And so I think there's different ways to be able to approach this, and also part of the dynamic is how our managers interact with the companies as well.
No, thank you very much, Adam. Sylvia, did you want to add to that?
Yes, please. Yes, thanks, Anne. Yeah, thank you, by the way, for the question, because it leads to bringing you back a bit to 4 years. In 2016, we spoke to Shell, but also to Total, Equinor, BP, and we asked them what they would do about their Scope 3 emission. As you all know, Scope 3 emissions are the one to talk about when you talk to oil and gas companies and their responsibilities. We've asked them to take responsibilities for their Scope 3 emissions. And And that was a full stop for most of them. Even for Shell at that time, they said, no, we cannot do that. It's not possible. It is not in our hands, and it is all something that people themselves need to do. Well, things have progressed since then, pressured by shareholders, investors, NGOs, shareholder resolutions. All that pressure did help companies to change, in their opinion, to progress, to go into that evolution or transition, if you call it like that. And I strongly believe that investors have been the basic ones to do so, backed, as I said, by, for example, Climate Action 100. But now I think it's time that we also need to progress as investors in those companies. We cannot, like some NGOs do, fully put the blame and the total responsibility on all the Scope 3 emissions of the oil and gas companies. I strongly feel that we as investors also need to progress and acknowledge that there is a limit to what oil and gas companies can do. They cannot do it on their own, I just told you. So in that sense, we need to change as investors ourselves. It is absolutely not a good idea to divest in those companies. As I said, they are the innovators. We need their technological capabilities to even talk about the Paris alignment and reach the Paris Accord. So, well, let's go also on in this evolution, in this transition as investors ourselves. That would be my message. Thank you, Anne.
Yeah, thank you very much, Sylvia. Seiji, from your point of view in Japan, how do you view this issue of the Scope 1, Scope 2, and also capturing Scope 3 emissions in this work?
Yeah, in terms of Scope 1, Scope 2 is quite generally accepted, but Scope 3 is slightly, far away targets, and also we need to do more of those education type of stuff there when we do any engagement activities. So I think we need to have we need to do more communication or engagement activities when we talk to the companies in terms of integrating Scope 1, 2, and 3 the emission scope. So I think there are more to be done in terms of their reporting practices, and I think, and in terms of our approach to our investment is that we have more demands out of our client base of the ESG integration or ESG incorporation into our products for both the active and passive funds on global and domestic equities. So I think those are the actions that we are taking and construct a portfolio or product in a way that integrate ESG, and within the ESG integration, obviously climate change will be one of the largest factor in constructing that portfolio.
No, thank you very much, Seiji. Cynthia, would you like to share another question that's come through the chat box?
We are getting a lot of questions, I have to say. It's a very interested audience.
Very good.
So we probably won't get to all of them.
Time.
Yeah, so let me just raise this next one because this is a hard question. So it is. You have raised the example of Shell as a success story, but please share where this engagement has been more challenged. What are the hurdles? How we as investors can help overcome those. So really getting at some of the very big challenges you faced with Shell and more broadly.
No, thank you very much for that question. And whatever we learn in one engagement where we make progress, we've then got to turn to the companies where it's even more difficult to make progress. So this is a great question. Sylvia, would you like to start? And then Adam, I'll ask you to join because you two are the co-leads for Climate Action 100+ on Shell. Thank you, Sylvia.
Yeah. I will first touch upon, if I may, what are in general the most effective ways of engagement. What are the key triggers that made companies change? And then I will end with 1 or 2 lines on Shell. Well, in order for our engagement to be most effective and to promote the improvement that we want companies to take, the active collaboration between companies and their investors is essential. We need to build a partnership with the company, and we need to have therefore deep knowledge of such a company. So building trust is something that needs to be done, and you do that in several ways. For example, making a statement and messaging at the AGM of the company, trying to make joint statements, just build trust with your knowledge, but also your good ideas as a shareholder or bondholder in the company to improve things. Also very much instrumental in this is that the leads, in this case Adam and me, find each other. Can be with different perspectives, of course. We are an asset manager, Adam is an asset owner. But with our perspective backgrounds and contacts, and our wide contacts, I need to say, we have success. Now I come back to Shell. Well, I have to be honest. For my understanding and for my background, I have been engaging with Shell almost my entire investment career. So there have been challenges along the way, a lot, from Nigeria, the oil pollution over there, Arctic drilling, to the reserve scandal of about 15 years ago, and only quite lately, like about 4 or 5 years, we are really talking to them about climate change issues. I didn't need to build that trust as such with the company anymore. But having said that, I also just said that in the beginning, Shell denied any responsibility on Scope 3. So what Adam and I did is really educate the company on how important it is. And not only with Shell, by the way, we do that with a lot of companies that we are investing in. So that has been the challenge that we have been on. Again, being backed by a big collaboration really helps to convince companies to do so. Over to you, Adam, if Anne is in agreement with that.
And
yep, no, I'll be short.
What would you like to add?
Well, I mean, I think the word partnership's key. I think is to build to the point that you can actually see the potential for partnership between our objectives and the long-term objectives, and that actually you've got a mutual interest as a long-term investor with that company's long-term transition. And how do you find that sweet spot of that alignment? When you've got that, you are in a very different space in terms of the conversation you had with the company. It doesn't mean that the conversations are not necessarily any easier and that you're any less challenging, but I think the dynamic is that you both have an understanding of your end goals here, and then the discussion gets into strategy and ways to be able to do that. And we've still got to do a lot of interrogation of underlying aspects. There's presumptions in this strategy, there's rollout of carbon capture and storage, there's use of nature offsets, biodiversity offsets, all of these kind of issues that I think we are still only as an investor community really getting to understand. But trust is important, time is absolutely critical. I think we totted up just in 2019, I think we had about 30 separate engagements with Shell. So that's a huge investment of time in that individual company between us, and that's meetings with the chair, the CEO, senior executives, leading thinkers in the company, etc., with other investors in smaller groups, just ourselves. And then ultimately the challenge has been to differentiate, and I don't think we've still done this yet. I think you'll see a paper from TPI coming out in the next week or two, which will, I think, provide an insight, but actually differentiating what good looks like in terms of net zero commitments. And I think we're at the cusp of being able to do that with confidence in the investor community. And then that point Sylvia makes, Shell can't do that by itself. I'm willing to acknowledge that they've got to have that change in their supply chain, and then that flows back to actually the way we engage isn't just with that company, it's through that whole value chain. We began a process this week to look how to do that in trucking in Europe, for example, in freight, and I think the answers are there, but you have the whole value chain, the people that buy the trucks, the people that make the trucks, the people that buy the energy, and that for me is where the CA100 really needs to step.
Yeah, no, thank you very much. And that's exactly the next area of focus. I couldn't agree with you more. Cynthia, another question from the
Yes, thank you.
participants.
I'm going to read two here and let you pick. They're both quite interesting. So the first question is, some large asset managers have talked about voting against directors where companies are lagging behind peers on climate risk. Do panelists plan on using their vote as a tool with companies to drive change? And then the other question here has to do with deforestation. Store Brand Asset Management recently has commissioned an RFP to assess the tools available to investors that might assist in understanding, measuring, and monitoring progress on deforestation by investees. Do you know if the results of this work will be available publicly to assist the entire investment community? So two very different questions. You pick.
Yeah, but I'm going, given that we are trying to cover a lot, let me ask each of the panelists to answer both those questions. So, Seiji, if I can come to you first, two questions.
Okay. Yes.
Are there circumstances in which you would vote against board members? And if so, please give us an example. And if not, maybe explain why. And the second question, deforestation. What are the tools that we need and how does that fit in with the overall strategy? So Seiji, to you
Yes,
first.
Okay. The first one, in terms of voting against directors, we have voting policies guidelines based, and our voting guidelines are based upon for the governance side. We have the governance. We measure. We vote vote against directors when as a kind of minimum standard. So if we feel that the governance of the company is under the subpar, so to speak, in those situations we may vote against those directors. That is so we do in some cases we would vote against directors when we decide that it doesn't it's not in line with the the discussions that we have been engaging. And in terms of the the second question is for the deforestation. We feel that the deforestation we need to have there has been a lot of data sets are being collected, and also we need to sort of identify the supply chains that are exposed to that, and that is I think, and also here we need to have a good engagement and raising the awarenesses of those the companies involved in those supply chains. So I think those are the processes is needed to have the more effective engagement activities going forward.
And
No,
sorry
thank you very much.
here. I just have been told I have a 1-minute warning, and so I will need to ask if you could please just make closing remarks. And thank you, everyone.
No, thank you to Ceres. Well, everybody, thank you for joining us. Please keep your questions coming for Ceres.
Yeah.
They will certainly be able to provide answers. Seiji, thank you for joining us from Japan. Sylvia, thank you for joining from the Netherlands. And Adam from London. And I'm delighted to join you from California. So thanks, everybody. Stay safe, and let's learn how to build back better, as the UN so beautifully puts it. Thank you.
Wonderful. Thank you. Thank you so much, Anne.
Bye-bye.